Today, let's discuss about Aditya Birla Sunlife Nifty 50 Equal Weight Index Fund. As you know, this is a passive form of investing, meaning it tracks the underlying index of Nifty 50 equal weight. Also, since it only tracks the underlying index and is a passively managed fund, it doesn't have much of an expense ratio when compared to the actively managed funds. I hope you have an idea of the expense ratio. Expense ratio denotes the fee that they charge to the investor for managing the money. Say for example, the expense ratio of a fund is 1%. It means if you invest 100 rupees into the fund, they charge you 1 rupee. They take 1 rupee as the fee for management and they invest the rest of the money, that is the 99 rupees, into the fund. It's an open-ended scheme, which means the funds are offered through the fund company directly to the investors, and one can buy or redeem shares whenever we wish to. It's an index fund, meaning it tracks an underlying index instead of actively managing the fund. It is a passive type of management of funds where it only tracks the index. The minimum investment is 500 and SIP options are available. There are two plans, as in like in the case of other mutual funds, direct or regular. Direct means we avoid certain brokerage charges, so direct option is preferred. We have the growth option or income distribution option. Growth option means whatever returns we get or reinvested in the fund. Then we don't have an entry load, we don't have an exit load, which is very good. The fund manager is Mr. Lovelish Salanki, and as discussed, this fund tracks the Nifty 50 equal weight index. And the risk profile of the fund is medium to high because it is an equity based fund. Let's quickly discuss about the underlying index fund, that is the Nifty 50 equal weight index, and compare it with the standard Nifty 50 index. There are certain similarities between Nifty 50 equal weight index and Nifty 50 index. One similarity is that both the indices contain 50 top large cap stocks. And the other similarity is that both these indices are reconstituted semi-annually, once in March and once in September. The reconstitution process involves taking some companies out of the list which do not meet certain eligibility criteria and which do not meet the performance standards, and hence these list of 50 companies are checked once again and the index is reconstituted semi-annually. Another similarity I can think of is both the indices contain companies from I think around 13 sectors. Let's quickly discuss about the major differences. One very important difference is that in the standard Nifty 50 index, the companies are constituted by market capitalization. That means the weightage is given according to the market capitalization of the company. That means the free floating market capitalization. Free floating market capitalization is nothing but the public's money and not the promoter's money. So if there are, for example, 4 companies in the index and each company A has 50,000 crores as the free floating market capitalization. Company B has say 70,000, company C has 30,000, company 4 has 40,000 crores, for example, as free floating market capitalization. So based on these values, they give weightage to the company. Whichever company is having the higher market cap, it will be given more weightage. The top companies are as follows: Reliance Industries 10% weightage, HDFC 9% weightage, Infosys 7%, and so on. So if you see this portfolio, it shows that Reliance is holding a heavy weightage. And just to let you know, Indian Oil Corporation has the least weightage, around 0.36%. The sectoral weightages are like this: financial services taking up the highest weightage, 37.82%, IT 16%, oil and gas 11%. The least weightage is given to fertilizers and pesticides sector. Let's remind ourselves that these weightages in the Nifty 50 are given based on the market capitalizations of the company. And in Nifty 50 equal weight index, we have to remember one very important thing, that all the companies are given weightages not like the market capitalization in case of Nifty. The weightages are given in accordance with a number, say 2%. All the weightages are made equal to 2%. Now if you see in this exhibit, we can see the top few companies and their weightages. The weightages shown here are not exactly 2% because the rebalancing is not done yet. The rebalancing happens on a quarterly basis. After the rebalancing is done, the values are set back to approximately 2% again. This essentially means that all the companies are given equal weightage, be it Reliance or Dr. Reddy's or IOC. Each of the companies is given equal importance, that is 2% weightage. But earlier in the case of Nifty 50, when we discussed that the weightages to the companies are given based on the market capitalizations, then in that case what happens is, suppose Reliance goes up, Nifty goes up a lot. Reliance has a big impact on Nifty because it has got more weightage. But in this case of Nifty equal 50, even if IOC goes up or Reliance goes up, the index will have equal impact because each of them is given equal importance. Yet another difference between Nifty 50 and Nifty 50 equal weight is that in Nifty 50 only reconstitution happens semi-annually, but in Nifty 50 equal weight, in addition to reconstitution, it also undergoes rebalancing once every quarter. During this time of rebalancing, they adjust the weightages. Suppose the weightages have gone off board like 3%, then they get it back to 2% by buying and selling shares of the respective companies. There is also a difference in the sectoral weightage between Nifty 50 and Nifty equal weight. In this section, we can see that there is a difference in the sectoral weightage between Nifty 50 and Nifty equal weight 50, which means the preference to the sectors has changed from Nifty 50 to Nifty 50 equal weight. Say for example, in the case of Nifty 50, financial services was given higher preference at 37.82%. But in case of Nifty 50 equal weight, the weightage changed to, the sectoral weightage changed to 21.52%. And let's take IT. In Nifty 50, the IT sector representation was 16.53%. Whereas in Nifty 50 equal weight, it is 9.81%. So essentially, the the sector representation of financial services and IT has considerably been reduced in Nifty 50 equal weight. So this is one difference. So you can look at the rest of the sectoral representations. One advantage of investing in Nifty 50 equal weight when compared to Nifty 50 is that there is a broader sectoral representation here. This means that there is equal weightage or equal allocation of funds given to the 50 large cap companies, rather than relying on the performance of only the few heavyweight companies. This essentially means that we are avoiding the risk of concentrating on the top-notch companies only. So the evident result is diversification. So the invested money is exposed to all the companies of the index, unlike weighted exposure to the companies as in the case of Nifty 50. Yet another difference is that Nifty 50 is momentum based and investing in Nifty 50 equal weight is value based. There are many pros and cons of value based approach compared to momentum based, which you can explore more. This fund by Aditya Birla Sunlife, the Nifty 50 equal weightage fund, is not the first of its kind. There was one more fund, DSP Equal Nifty Fund, which was launched in 2017. The assets under management for DSP Equal Nifty 50 was around 150 crores and the expense ratio was 0.39%. Apart from DSP Nifty 50 equal weight fund, I didn't find any other funds in this category. So if you know any of such funds that I can compare with, please let me know. Let's compare this equal weight fund with a standard Nifty 50 index fund. Say for example, if you take UTI Nifty index fund, the expense ratio is very less, like 0.10%. I'm only talking about the direct plans and not the regular plans. So essentially, if we compare Nifty 50 index funds with Nifty equal weight 50 index funds, it is very obvious that Nifty 50 equal weight funds are going to have higher expense ratios compared to the Nifty 50 funds. The changes, the differences in these expense ratios might be very less if we think of short-term investment. But if we think of a long-term investment like 20 years maybe, these expense ratios matter a lot. But it is very natural that Nifty equal weight 50 expense ratios are higher because of the higher turnover. Coming to the tax implications, I don't think there are any major differences in the way the returns are treated in terms of taxes. As usual, the short-term capital gains taxes are taxed at 15% and long-term gains are taxed at 10% above 1 lakh. So there is no added tax benefit in investing in this fund. Coming to the $1,000,000 question, will an investment in this fund give us more returns? For that, let's look back at the history. Let's compare the performance of Nifty 50 index with Nifty 50 equal weight index for about 20 years. As you can see, the dark blue line represents Nifty 50 equal weight and the red line indicates Nifty 50 performance. Nifty 50 equal weight index has outperformed the Nifty 50 index for 13 out of the last 22 calendar years. Let's see how Nifty 50 equal weight has performed post a crisis situation. Say, for example, Nifty 50 equal weight index outperformed Nifty 50 in 2002 and 2003. That is after the 2000 dot-com crash. Now let's take 2009 for example. After the 2008 global financial crisis also, it has outperformed. And during the recent COVID pandemic, that is in Q1 of 2020 also, Nifty 50 equal weight index outperformed Nifty 50. But in 2018 and 2019, say for example, when the market rally is narrow and is led by only few large companies, then in that case of a narrow market rally, Nifty 50 equal weight tends to underperform Nifty 50. All in all, it appears that Nifty 50 equal weight has given more returns, slightly more returns compared to Nifty 50. Let's look at the volatility profile of Nifty 50 equal weight and compare it to Nifty 50. So as you can see from this exhibit, Nifty 50 equal weight index volatility is broadly similar to Nifty 50 index. Since June 30, 2009, the Nifty 50 equal weight index has had slightly lower volatility compared to Nifty 50. However, over the last 10 years, between January 31st, 2011 and January 29, 2021, the Nifty 50 equal weight index has slightly higher volatility compared to Nifty 50. Overall, I understand and what I infer from this is that the volatility profile of Nifty 50 equal weight is slightly similar to Nifty 50, not much of a difference. If we consider the return to risk ratio for Nifty 50 index, it's actually 0.58, but for Nifty 50 equal weight index, it's 0.68. This is if you consider the data from 1999. All in all, I say that Nifty 50 equal weight has performed well in the last years compared to Nifty 50. Also, the volatility is not showing great numbers. And given that market cap indices so far have performed better than equal weight indices in the last few years, it means that probably reversion is on the cards. Moreover, equal weight indexing strategy is one of the smart beta approaches. So, smart beta approaches tend to give better results over time. So let's discuss a few more examples internationally where there are some equal weight indices. Let's compare the famous S&P 500 ETF with the S&P 500 equal weight ETF called RSP. Of course, our case is not ETFs, but that is the data I have here. So let's discuss the difference in the returns of these two ETFs. One is S&P 500 and the other one is RSP. If we consider the data from 2004 to 2020, RSP, that is the equal weight index, gave a total of 365.95% in comparison with the standard S&P index, which one is 350.77%. The difference is a whopping 15.18%. Now, looking at all these kinds of data, I can't help but be convinced that equal weight indices are giving slightly higher returns than the standard indices. So in this case, Nifty 50 equal weight was giving slightly higher returns than Nifty 50, but the risk difference is not that much. So this is a favorable point to understand. So all in all, there is no one strategy that wins forever. This is just one flavor of investment that we can include in our portfolio. And one more thing to understand is that the importance that we give to sectors vary in Nifty 50 equal weight index compared to Nifty 50. Say for example, consider the pharma sector. In Nifty 50, whatever weightage or importance is given to pharma sector gets doubled when it comes to the case of Nifty 50 equal weight. Same is the case with the difference between other sectors like auto, oil and gas. So if you think these sectors will perform well in the future for some reason, and if you have your own analysis to conclude and confirm that, then kindly go ahead and invest in a Nifty 50 equal weight index related strategy. All in all, investment in Nifty 50 equal weight tends to give a different flavor and better return compared to Nifty 50. So I'm not suggesting that you sell all your Nifty 50 investments and put them in Nifty 50 equal weight, but all I'm suggesting is that we can include this kind of investment as an additional flavor. But now the question is, should we invest in Nifty 50 equal weight through Aditya Birla fund only? My answer is, my personal opinion is no, because this is an NFO. It is a new fund offer that Aditya Birla is giving to us, but I am personally against NFOs because first thing is, in an NFO, the expense ratios tend to be higher because the assets under management are lower. So there are specific guidelines and suggestions for them to increase their expense ratios. So unless and until I am clear about the expense ratio of this fund and I can be confirmed or affirmed that this expense ratio will be kept to the minimum, I will not go ahead and invest in this NFO. Instead, if you want to really have an exposure to Nifty 50 equal weight indexing strategy, then I would suggest you go with an existing fund like DSP. But I didn't see any other ETFs related to this category. So all I can see is a DSP fund. So if you really want to have an exposure to Nifty 50 equal weight, you can just go ahead with that and invest some amount. But whatever it is, The idea is that we have to hold on to it for long term, at least 10 to 15 years, to enjoy the benefits and see the comparison of its outperformance when compared to Nifty 50.